Okay, here we go. Good morning, everybody. Thank you so much for being here or watching this recording. My name is Kobe Rex. I am a loan officer, and I am here with my training manager and program manager for my divorce lending. This is Tammy Ita. So what we're going to be talking today real quick, I called this the Festival of Broken Promises. So what I have dealt with recently in my last three cases has been specifically some areas where the borrower was the one of the parts of the divorce was promised that they were going to be able to refinance the house, but then all of a sudden there was an issue on a credit report. And then also we would have issues where one of my clients thought that he was going to be awarded the house and we were going to do a refinance, but we ended up having to switch that and we had to move it over to helping him find a new house with barely any money for down payment. So ultimately, what we wanted to do today was kind of talk about some of the issues that we're seeing for both clients and then also realtors and then also divorce attorneys or mediators, anybody specifically going through these situations. When you're in the middle of it or you're creating your decree, you're probably not you're probably not thinking about a lot of these things when we're going into them. And really, what we're hoping from today's presentation is that we can give you a little bit of a taste of some of the lending issues. And then ultimately, we're not here to make you an expert. What we're really here to do is just sort of lay out some things to think about. And one of the biggest reasons why we do these presentations is so that way, if you have any questions, we would love to help you in future cases down the line. So, with that being said, I'm going to share my screen and I'm going to let Tammy take it away.
Okay. This morning, we're going to be concentrating on some specifics, like Kobe said, and these are some basic outline of what we're going to go about. And what we try and point out when we're going through these is during negotiations, during the drafting process, here's some things that we've run into because certain aspects of this in the debt to impact or debt allocation sections and in timeframes for transferring real property or refinancing, those kinds of things. It's hard to think of everything. So we're just going to point out a couple of things and hopefully it gives a little bit of a hook to remember the next time maybe you run across this, either for yourself or for clients, that you're able to go, oh, wait a minute, we have a question about this and we know we can do this better. So that's what we're about today, is just pointing out a couple of things to help everybody in a difficult situation, but help at least this process go more smoothly for post-divorce housing situations. So go ahead. So in the final decree, it may say over here on the left side of your screen, you'll see debt allocation. In that section, it says the primary home's going to get refinanced and to one party, and it gives 2 years. Everybody thinks, oh, wow, that's a lot of time. No problem. It'll happen. There's an automobile that needs refied so that from both people owning it, that one person owns it, and more importantly for lending, where the payment comes from. So there's some aspects here that can cause people issues. And yeah, they've got 2 years to do it. During that 2 years, though, it messes up both people's credit potentially. So anytime they do need to, purchase a home or refinance something on their own or something, it impacts it for that entire 24 months. The final solution here, as Kobe said, he has a specific case 1 year and 8 months after the final decree. His lending client originally needs $289,000 to refinance the primary home and initially wants to get a little cash out for some other things, pay off some debt, that kind of stuff. So 330,000. And going into it, they're like, oh, we've got a cosigner, so we're golden, no problem. Well, the auto refinance didn't happen yet. And so that $600 a month payment is still coming out of a joint account. Almost 2 years later, it's out of a joint account. That's a problem because now that $600 a month applies to both, even though the other party is who's been paying it, should be not a problem, but because it's on a joint account, it still stays on the lending client's credit. So the cosigner, you think no problem, cosigner's going to, make up the difference. Well, cosigner has some debt of their own. So the fine and mortgage loan to make this happen for a purchase is now $450,000.
Hey, Tammy,
Yes, go
can I
ahead.
come in and do a little bit of
Yeah,
explaining how this makes sense?
yes.
Yeah, so basically what the main issue was this the loan, the $600 payment. It was, I literally remember it. I was like, why is Harvester's Credit Union this such a big issue for me? It was $589, but literally what it was doing was that it was putting the back end ratio, which is their total debts. It was throwing it because this was amazing because this was a VA loan. So we could raise the tolerance pretty high. We had like a 66% back end ratio. But ultimately, the borrower came to me, the wife, and was like, I really need 20,000 because I want to go to nursing school. We still have to pay off the pool, and I just need a little bit of fluff money now that my mortgage payment's going up. So ultimately, um the other side, the co-signer was her dad, and her dad, we actually had to pay off his little baby $47,000 mortgage, which because they had an $831 per month payment because we couldn't exclude Harvester because it was in a joint account, so we couldn't say that the husband was paying for it, even though he was. Um, so ultimately, we had to get rid of that mortgage so that way we could throw the limit even higher that we could finance. And it was actually really nice because we were able to actually get $42,000 out for the client at this loan amount. But I mean, even for this, there was really hard. It's really tough with VA for doing co-signing. We had to sit there for 2 weeks just waiting for our stuff to be reviewed because it wasn't a married set of borrowers. So literally, we're just like, okay, we want her to pay for Christmas and she doesn't have her money because we're waiting during government shutdown for them to review our file. And it was just so many different pieces that the nice thing is we were able to get it all done. But there was like 3 nights where I had to walk through with this client to be just like, okay, door A is no longer going to work because it's not going to get you enough money out. And then all of a sudden she's just like, well, I just want to have the as little as possible. So we were like, okay, are we going to do 420 or 430? And then because we had an appraisal at 500, so you can do up to 90% loan to value. And then finally, what ended up happening was that we were just like, okay, if we're just going to do this anyway, let's just do it permanently and let's go all the way up to 450,000. So that thing, though, as you can imagine, we went from a $330,000 payment up to a $450,000 payment, which luckily we could do. But as you can see, I will let I'll let Tammy get back. I just wanted to really make sure that we saw the whole picture because there's a lot of moving parts of this that ultimately ended up working out, thank goodness. But I'll let Tammy get back to it.
Okay. Yeah, we want to avoid in all of this, the 2 years timeline seems like it's great, plenty of time. In the one respect, the decree did have a timeline, so good. But sometimes without someone talking them through and going, okay, is that really what you want? Number one, do you want all of this to stay on everybody's credit for this long? Because getting pre-approvals, getting qualified to then look for a new home or whatever might be happening in post-divorce world, got to think about these timelines, whether they're super short or they might be long. Think about the impacts of that to their credit, to debt to income ratios. Revolving credit accounts count in all of this, where the payments are coming for count in all of this. So we're just really trying to, raise awareness of those types of things. So then, we're hoping that at least people can ask the question of themselves or of their clients and really pay attention to the impacts of the real property sections and the debt to income and debt and income allocations so that timeframes can make sense, so that properties, whatever is going on with them, could make sense. And, sometimes what happens is a court may award a property to one party over another, even though the decree originally had a different solution. So they might go in thinking, oh, we're good. We've decided what we're doing. And for one reason or another, the court may decide a different thing altogether. That's another case that Kobe's had recently that, you know, without being prepared for something like that or without knowing or being clear in the terms, boy, you can really land yourself in some interesting situations. Can be worked
Well,
out,
Tammy,
but it's
can I
interesting.
can I
Yes, go
give
ahead.
context on this one? Yeah, because like basically, so if I was advising this client, what I would have loved to have done is, let's say, right after we finish the divorce decree, even though we have this 2 year timeline, because of the fact that I'm a lender and know that I could have asked, like, I could have gone through all of the liabilities because Tammy did a great job on, I think, two presentations ago, lining up how, what is it called again? The property and financial,
Oh, the post-divorce questionnaire, housing solution
yeah, the post-divorce
questionnaire.
questionnaire. And then there's like the part where it talks about how everything is lined up, part six and
Oh, yeah,
seven.
the different sections for the debt and income allocations, who gets what when, who's going to own it in the end, and by when do they need to own it? And then in the real property section, kind of the same thing. Who's getting
Yep.
it? How is it being transferred? Is it being sold? Are there liens? Who's going to own it? And when do they have to own it by?
And that's what I would have fixed for this client is I would have basically said, "Hey Jenny, I know that this specifically says that we are going to um you're no longer part of this car, but where is this getting paid?" Okay, great. Maybe if we could have dealt with this a year before, because it takes 12 months of history for us to basically exclude a debt, what we could have done is gone and said, "Hey, please make sure that your finances are separate in here because even though this is going to like, and here's the thing, I'm going to be a lender for a long time. I am totally fine with saying we're doing this today because in 2027, we're going to close something because these relationships happen for a long time. But what a lot of, I mean, ultimately, typically what happens is literally I called the realtor and was like, "Hey, we're starting to see some rates go down." And she's like, "I've been sitting on this one for forever. She's needed to get her stuff done." So I'm not trying to pretend that we're living in like La La Land where everything is so great. But at the same time, there are positions where if you have a client that is going to be doing something within 2 years, because I have another divorce attorney that we've worked with that talked about how they are waiting until after the new year to do the divorce so that that way they can reduce their tax liability by not having to deal with uh, taking care of that asset. So it really is not just if you look at a transaction just as, hey, I want to just try to just get this done, we can do that. But with a little more foresight, I think which Tammy has been talking about, which I'm going to give back to her, is this can be, I think, Tammy, what's the word that we use to describe what we try to do? Risk mitigation.
Yes, it's risk mitigation. I mean, situations like this have so many emotional impacts. Some of that we get involved with because of the mortgage and what people are going to be living in after all of this is done. But just trying to help bring a little bit of clarity to this aspect and maybe make it less fraught. And that there's reasons, like you said, sometimes there's tax implications. Sometimes we do need to pay attention to their credit ratings and to the debt to income ratio and those kinds of things. But in all of this, timing could really solve a lot of issues, and being just clear about it, spelling it out, less likely to have to go back to court, less likely to have to, you might still have issues with whoever your clients are splitting from, but at least this aspect doesn't have to be as crazy as it might otherwise be.
Tammy,
So, and
can I
sooner
jump
is
into
better
this?
than later. Yeah.
Yeah. Can I jump into this example?
Yes.
Okay, yep. So, and Tammy just brought this up. One of the other things too, especially as a professional and even as someone going through it, just because your attorney says, "Oh, for sure this is what you're going to be awarded. This is exactly what you're going to get," until the ink is dry, we need to plan for what can happen. I had a client that was in Indiana that when he called me was so sure that he was just going to be refinancing the property, that he was going to um and that he was going to be basically paying out the equity portion to his wife. Little do I know, I sent him text the night before his hearing saying, "Oh my gosh, I hope it goes so well." The next day, I get a call being like, "Oh my gosh, that went so poorly." I did, of course, he said it much differently than that, but we're going to say that for the recording today. um, and then basically, now he's like, "Kobe, I don't have any money and we got to go find another house."
Wow.
So for me, you're not going to hurt my feelings if ultimately we're talking about being in a divorce situation and you don't know exactly what's happening. We can pivot on the fly and just know that for us, just because an emotional client or an invested client think that's happening, something's happened a specific way, us as professionals are not going to do anything until we know for sure what that divorce decree is going to say.
Mhm.
So I'll hand it back over to Tim.
Okay, and I think we can go on to the next slide as well. So what we recommend and what we look at and what Kobe digs into and gets details and is ready to pivot is that, you know, if the decree says that the home needs to be sold and say that they're getting ready to file that decree, there are some situations, quite a few actually, that there's not a problem. The parties are just like, yep, this is what's happening. We're good. In looking at that draft decree, or, when it's getting ready to be finalized and filed for processing, is okay. Everybody, there doesn't seem to be an issue. Okay, our recommendations are if there's nothing stopping you, go ahead and get that home listed. Don't wait until the months down the road when the divorce decree is going to be final. And then it says you're supposed to sell the home in 30, 45 days after the final date. That's just, maybe in some markets that can happen, but in a lot of markets, it's going to be on the market for a little while. So, we look through a draft decree for things like that. If whatever's going to happen with the real property, do they have enough time? Could they list it now? Or could they start the refinance now? Maybe you need to make sure that any closing that comes up or anything is closer to the time when that final decree is going to happen, but at least you're prepared. You're not starting at square one. You've at least done some work ahead of time to know how long that's going to take. And then the window for refinancing or for completing certain things, we can advise a little bit. Kobe works in numerous states. He can advise on what the average time for getting to a closing is, or those kinds of things. He knows that. If you're a realtor, you know it in your case, but at least if you've got a client that you're talking to, just say, generally speaking, it's going to take this long. How about we, get this listed and at least, we could schedule the closing for whenever, but let's get going on something. And then revolving accounts, or actually any payment that's coming out, again, make sure it's not coming out of a joint account. If it's going to go be owned by somebody, well, even if you want to wait to do the final on some of this stuff, at least get it prepared, be ready so that when a final decree comes out, you're actually ready to sign and not taking, those folks gave themselves 2 years to do that. They're at 1 year and 8 months and running into some issues. It gets kind of crazy for everybody. Um, and just being looking at those timeframes and that, and Kobe could really look depending on the state, depending on the market, working with whoever folks are working with. Um, he can make some recommendations on that. And that can really help people's expectations and setting and mitigating their issues and trauma regarding these issues. if they know and can set some decent expectations on this.
Perfect. Well, sweet. So I'm going to stop sharing real quick.
Yep.
So I'm going to stop the recording here real quick. So for anybody that's watching on the recording, if you have any questions, you know my LinkedIn stuff. I'm available via Messenger, and I have my phone number there. You can reach out to us, and we can talk about all that. So we loved it. We're going to be doing our trainings again starting in January, on January 9th, and then January 23rd is going to be our other one. So I'm going to stop the recording.